You do not have to wait until your divorce is final to buy the house. I know that's the opposite of what almost everyone tells you, but it is true. You can buy a home in the middle of a divorce without draining your saving or selling the things that you fought to keep. One of my clients was so sure that she only had one choice. It is to pay all cash for the purchase. She walked out with a new home, her kids in the same school, and her settlement still in her pocket. I'm Lee. For more than 20 years, I have helped over 2,000 families to find the right loan, including people right in the middle of a divorce. In the next few minutes, I'll show you the best time to talk to a lender and 2 ways that you can qualify and how to close in your timeline, not the courts. Let's get into it. Let's start with timing, because this is where most people get it wrong. Most people think that they have to wait until the divorce is completely final before they can even talk to a lender. So they will wait, and the waiting is the mistake. The best time to talk to a mortgage advisor is when you have the preliminary settlement agreement, not the final decree. It's early. Here's why it matters so much. When you know your home financing options early, you can use that knowledge while you are still in negotiation for your settlements. Think about the questions you can answer before you sign anything. Can you qualify your own income? What happens if your ex-spouse's income is on the applications? And what happens if it is not? If the support amount changes, how does that change affect the home that you can afford? When you know the answer before the negotiations, you walk into that room with a real leverage. Sometimes that helps just you. Sometimes it helps both sides to reach terms that actually work, because everyone needs somewhere to live. So it is not really about when you are allowed to apply for a mortgage. It is about making sure your settlement sets you up for the life that you are moving forward, not the life that you are living. Now, once you know the timing, the next question is the big one. How do you actually qualify? And this is where most people are surprised, because there are 2 different ways, and most people only ever heard of one. Let's talk about the first way, the one that you already know. Most loans, your regular 30-year mortgage, an FHA loan, a VA loan, they all look at your income against your debt. They want the divorce to be final, and to count things like alimony or child support as income. The lender needs to see that you have received those payments consistently on paper over time. If you have a steady job and documented support, this path can work well for you. But there is a second way, and this is the one that changed everything for a lot of people. This second way does not consider your income or debt at all. It qualifies you using the assets that you already have and the asset that you are receiving in your settlements. We call this asset-based lending. With this path, you do not have to wait for divorce to be final. Your settlements assets, the equity from your home, stocks, investments account, and retirement funds become the way that you qualify. As long as the monthly payment makes sense next to what you have, you do not need to cash everything out just to buy a home. Let me tell you a client of mine, because she's the reason I talk about this so much. She was right in the middle of her settlement. She and her husband had agreed to sell the home, and each would buy a place of their own. She had been a stay-at-home mom for a long time, and she had just started a part-time job. That income on its own will not qualify her for any mortgage, not even close. So in her mind, she had only one option: pay all cash. Take the money from selling the house and hand it all over to the new one. I sat down with her while she is still in the preliminary settlement stage, and I show her the asset-based options that she did not know she had. And here's how it turns out. She moved into the new home with her kids in the same city and school district. The money from the sale that she thought that she had to completely spend, she kept it. Her investments and retirement account untouched, and she walked away with money set aside to fall back while she's building her new life. She walked away thinking that all cash was her only choice. She walked out with a mortgage, her settlements protected, and her kids in the same school. That is what knowing your options early can do. And honestly, I'm not a fan of watching someone pay capital gain tax on stocks that they sold or pay a penalty on a retirement account that they cashed out just to qualify for a mortgage that they could have gotten another way. She thought she had only one option. She had more. She just needed someone to lay them all out. Here's the line that I want you to remember. Your wealth speaks for itself. Quick thing before we keep going. If you are already sitting there wondering what your settlements could qualify you, this is the easiest part that we can find out. Send me your details and we can look at it together on a short call. No cost, no pressure. The link is right below this video. So to make it simple, your home equity, your stocks, your investment account, your retirement funds, all of this can be used to qualify. As long as the payment makes sense against what you have, you do not have to drain your settlement or pay tax penalty just to qualify. You use your assets to qualify and you keep them. And just so you know what's possible, a program like this can go up to $3 million on loan with around 40% down payments and no tax returns needed. Or it can go as low as 10% down up to $1 million loan for a primary home. Every situation is different, so we would confirm your exact numbers, but that's the kind of room that we can give you. Once the right strategy is in place, there's really only one thing left to do. Once you have your strategy figured out, the right loan, the right timing, the right fit of your settlements, you get close to your new home on your timeline, not the court's timeline. Not your ex-spouse, it's yours. And this is what it looks like when your preliminary agreements get signed and you already know your option. The divorce becomes final and you already pre-qualify. The settlements money comes in and you already know exactly how to use it. You are not scrambling to figure it out on a mortgage on top of everything else that you are carrying. The plan was already in place. You do not need to have every part of your life figured out to start this conversation. You just need a rough idea of what your settlements will look like and what your next chapter is going to look like. If you are in this situation right now, even if your preliminary agreement is not signed, the most valuable thing that you can do is to get a quick 15 minutes call so you understand your options before you actually need them. That is when your choice are the widest. No cost, no obligations. Let me leave you with this. Most people going through a divorce thinking that they have only two options: wait or liquidate. The strategy I just walked you through is the third option. It is real, it works, and the earlier you learn about it, the more your settlements it's for you to keep. So let me ask you, are you in this situation right now? Do you want to see what this could look like with your actual numbers? The link is below this video. And if a major life changes hit you and no one has ever sat down and explained your mortgage options, subscribe. That's exactly what this channel is here for. I will see you in the next one.